We are now a little bit ahead of time, which is great, and we'll run into the question phase of today's session. I'll move to Richard first, actually, because we've got a salary sacrifice question, which is regarding salary sacrifice. Isn't this age discrimination by government? So individuals who were on salary sacrifice for many years and near their retirement were able to save towards retirement saving national insurance. However, for the younger generation, government have changed the rules and therefore they were not able to save towards pension in the same way. Yeah, very fair point. Great question. Richard, what have you got to say on that?
Yeah, very, very good question, Chris. And that very much speaks to not only the tax and social security impacts of salary sacrifice, but also, the importance to individuals of pension savings, the importance of being able to access, efficient mechanisms to save for retirement, because we've all obviously seen headlines over and above those regarding pension salary sacrifice, regarding the challenge of getting more of the UK saving for retirement. We know that the state pension in real terms is becoming less valuable. And we really do need more people in the country to save personally for retirement. And I agree with the person asking the question that pension salary sacrifice was a key mechanism to support that. And I do agree that actually steps to limit that mechanism are not not welcome. They are not we would say a necessarily constructive step, although the government's view would be that they are seeking to to increase the tax take where they can, for other pressing government finance reasons. So there's rationale on both sides. I think it's very interesting, as we covered in the presentation, that the timing is so far out, 3 years before these changes take effect, and introducing that £2,000 per year cap. So perhaps part of that would be for individuals to make the most of it whilst it's still whilst there's not that limit on it. Can you use the next 3 years to save as much as you can into your pension pot? I mean, clearly we're not offering any form of financial advice here, but that is a potential for individuals to look at and to take their own advice on. And really, for employers who are offering these arrangements, maybe the message is broadly the same. What can you do to help your people get the most out of pension salary sacrifice in the time, between now and 2029? And of course, 3 years, it's a fairly long time, isn't it? We may see changes and evolution of the position in that time. Maybe other ways of saving, efficiently into your pension will be available that you can explore now for your people, for yourself individually, and see what is available. So we share that frustration. We as advisors have seen the benefit of pension salary sacrifice for many years now, and I think curtailing it is not really a step in the right direction for pension savings in general. But do what you can now, plan for the future, and see what steps you can take to alleviate that impact.
Thanks, Richard. Yeah, great comments there. It does feel like a very short-termist policy, and hopefully in the future, once the coffers are in a better position, there'll be more incentivization for people to think medium and long term, etc. Okay, we'll come to Jonathan with the next question around the permanent establishment conversation. Is there a specific number of employees in a particular jurisdiction whereby you always have a permanent establishment? X number of remote sales employees as an example, when there is no other business connection. Yeah, Jonathan, what's thoughts there?
Yeah, that's a good question. I mean, it would be nice if we lived in a world where there was if you've got this number or you're carrying on these activities, then you fall within this category and you do have a PE, or vice versa, a kind of de minimis value or number of employees or number of workers. Unfortunately, it's more complicated than that, and you can create a PE if you've only got one remote worker, even through employed through a sort of an employer of record or a PEO. That can still come back to James's point on the sort of the substance of that arrangement and the economic sort of flows there. That can still create a PE. So even one individual Clearly, the tax exposure is higher, or the potential tax exposure and sort of interest penalties, all the other bits and pieces. That's obviously going to be greater with a larger number of people. And to be blunt, you'll be on the radar more if you've got 100 people in an office in France. You're gonna catch the authorities' eye there, versus one remote worker in a 0% jurisdiction. Perhaps that's less of a risk, less of a concern. But no, there's no sort of hard and fast number or value attached to that. So always worth looking at the scenario. Some we can sort of look at and go, yeah, okay, that's fairly clear. There's no problem. Others, they require a lot more analysis to get comfortable. So yeah, unfortunately, no nice, easy answer to that one.
Yeah, exactly. I think one person could create a permanent establishment, 10 people could not in theory. So yeah, it's very, very complicated on that front. David, there's a few questions on the capital allowances and other points. I'll come to you next. On the 40% main pool first year allowance, the first question was around, is it applicable to corporates as well as unincorporated businesses? And then some comments around the short life assets and leasing rules would be great.
Yeah, so on the 40%, I think, I mentioned that because it's available to unincorporated businesses, whereas full expensing wasn't. The 40% is available to corporates, but I think in reality, we're not going to see that so much. The reason being that full expensing is available on those main rate assets. So in reality, you're going to see corporate businesses claiming full expensing, which is more beneficial than the 40%. The exception to that is incorporated businesses who do lease out their assets. So that's where the 40% comes in and is beneficial, because full expensing wouldn't be available for those. What was the other question, Chris? Sorry.
Yeah, about short life assets. Again, we're happy on the full expensing would apply, so less relevant these days.
Yeah, agreed. So obviously long life assets that I spoke about earlier, they will fall into the special rate expenditure, which get the 50% first year allowance rather than full expensing. And on short life assets, those will qualify for full expensing, provided they meet the underlying criteria.
Yeah, fantastic. Okay, and there's another question that I can kick off with, and David, you can come in on, is what are the impacts on the corporation tax computations for the changes to FRS 102 for operating leases from 1 Jan 2026? Yeah, so I think the key point there is great for listening. You've taken Neil's session and David's sessions and brought 2 points together, so very impressive to that listener, etc. I think those rules are going to mirror what's already been a rule for IFRS purposes for many years, etc. So historically, you may have deducted rental payments. Going forward, you'd be deducting depreciation and right of use assets and finance costs. So a slight difference as well. So it could, in theory, accelerate your tax deductions, creating a cash tax saving, but would also have deferred tax implications as well. So you need to review it on a lease by lease basis and work out what the current and deferred tax implications are. But David, anything else to add on that front before?
No, as you say, I think the key point there is, although it might look different in your P&L for tax purposes, the nature of that operating lease remains the same. So you'll take a deduction for the P&L items, which will be the right of use, asset depreciation, and the finance cost. I guess the only other thing to think about is, and Neil might be better to talk about this, is in cases where you might have a transitional adjustment. Some thought does need to be given to that from a corporation tax perspective, whether that's deductible in full upfront or whether it is spread. Sometimes the tax rules spread that deduction, and that can give rise to deferred tax impacts as well, as you alluded to, Chris.
Fantastic. Thanks, David. I think that's everything from a corporate tax perspective. Is Sue still online for the VAT aspects? I think there was a few questions on e-invoicing that came through, and I think one of the points was, is this UK to UK or cross-border? I think it's a really good question. One, the big picture globally is that e-invoicing rules are popping up in different locations in different times, etc. So it's really important for global businesses to have an e-invoicing strategy for their entire finance system, and be able to tick off the early countries. I think Poland and France are some of the early adopters. Then UK is coming in. Some Far Eastern locations have already been well ahead of the curve on this front. So very important to touch base with Sue or one of our VAT specialists and talk through the e-invoicing requirements and how it will impact your business and how you are at least on the curve, if not ahead of the curve, because being behind and can lead to some significant headaches and penalties and such like on that front. Okay, and there were some great questions on the economic section as well around what is the view on the bond market if we have a change in Prime Minister. It goes back to Joe's point about any predictions regarding the future are very difficult, but it is very clear that any uncertainty, like we had in Kwasi Kwarteng's budget that spooked the markets, will lead to an increase in bond rates. So if there is some uncertainty for a period, that is like to increase it. Whether that will drop down below its current levels thereafter will all depend on the new Prime Minister and their approach and level of confidence and such like. Okay, there are a number of specific other questions that we've got here, but we think it's probably best, given that we had still got over 500 people on the line, that we'll cover those separately after the event, so people do get a more detailed, tailored answer rather than run through everything today. But that just leaves for me to say thank you all so much for attending. Thank you to all our speakers. You know, a lot of preparation goes into these, and we covered an incredible amount in a short space of time. So thank you to all the speakers online and in the room as well. And thank you to Emma and her team, who do all the incredible logistics behind the scene to make this as seamless as it possibly can be remotely as well. So happy Lunar New Year to those that are celebrating. Everyone have a lovely afternoon, and we'll look out for future events in the not too distant future.